Hit it.
It's Friday, July 4th, 2025, episode 267. I'm Patrick Serezna.
And I'm Kevin Muir. This week, we have the great pleasure to welcome Peter Berezin from BCA Research to the podcast. We have a terrific discussion about why he feels the economy is near stall speed and how he has gone from one of the most bullish analysts a few years ago to one of the more bearish today. It's a fascinating discussion you don't want to miss.
All right. And we might have a beer or two here, Kev. You know what? I don't want to ask Daniel to describe it, Danny. Danny, are you having a beer? Is it something more interesting than what I'm drinking?
That's Corona.
Oh yeah. See, like we really dropped the ball here, Kev, because we used to have all these interesting beers, and now like it's we're getting summer lazy, and all I've got is a super bock from like the local grocery store. It's like I don't even want to talk about it. All right,
Patrick made a new word. It's summer lazy.
Yeah, there you go. It is.
Okay.
It's everyone's a little bit of summer lazy. All right, Kev, give us some disclaimers here, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned on the show. Side effects of too much huddle may include the tariff tantrum disorder.
I'm nervous about that one.
Yeah. The forward guidance fatigue. That one's actually very important right now.
Yeah.
And then finally, the margin compression anxiety syndrome.
Oh.
Yeah.
Ouch.
All right, let's get the guest on.
It's our great pleasure to welcome to the show Peter Berezin. He is the Chief Global Strategist at BCA. Peter, thanks for joining us.
It's my pleasure.
I've been looking forward to this for a long time. I get to meet a fellow Canadian that is as bearish as me.
That's right.
So before we talk about your market calls, let's get to know you a little bit more. Tell us, like, did you grow up always wanting to be in the markets, and how did you get stumble upon this career?
Yeah, that's interesting. I started my career at the International Monetary Fund, where I wasn't really involved in the markets. I was doing a lot of economic research, negotiating deals with various countries, but not really market related. But it was kind of the early 2000s, and okay. I was very much interested in the stock market. I was actively trading stocks. In fact, I had a blog back then, which I believe still exists. If you go to stockcoach.blogspot.com or Google okay. Stock Coach, it's still there. And I would trade microcaps, and I got really interested in financial markets, and I got interested in trading, investing. And so an opportunity presented itself in 2007 for me to go to Goldman Sachs. I went there for 3 years, really loved it, learned a lot. But then I had another opportunity to go back to Canada in 2010, and I took that opportunity, and I've been at BCA Research ever since.
Living in Montreal. Did you, you mentioned you were at the IMF. Can I ask what your background was at school? Like, how did you come upon that job?
Well, I got a PhD in economics.
Oh, you did? Okay,
yeah, and that's the usual way that someone gets a job there. I mean, it was quite the experience to all of a sudden be in this sort of very, very interesting role, flying around the world, meeting all sorts of important government leaders. I enjoyed it. I learned a lot, and it was one of those foundational things for me.
And did you go to school in the U.S. or Canada, or a little bit of both?
I did my master's at the London School of Economics, and I came back to Toronto to do my PhD there.
Okay. And was Mohamed Al-Arian, was he also at the IMF, if I got that wrong? Did you guys overlap?
We didn't overlap, but he certainly was there.
Okay, so you're the same kind of career path there and stuff. Okay, so you go to Goldman Sachs. That must be quite the difference, moving from this bureaucratic, organization or at least a government, quasi-government organization, to this very entrepreneurial, very just fantastic organization, Goldman Sachs. Can you tell us a little bit about your experiences there? And it was also coincided with a tough time in the markets.
I joined April 2007, so it was quite interesting to actually spend time on the trading floor during the crisis. And I think right now there's kind of this perception that like everyone at Goldman knew what was going on. no one had a clue. People were just completely puzzled by everything that was happening. I remember somebody, one of the analysts, made a call to buy, I think Lehman,
Okay.
just before they went bankrupt, and I bought on the Friday, and I remember like driving my car on the freeway and just seeing a notification that they went bankrupt after I just bought the stock like 24 hours earlier. And I wasn't paying attention. I was kind of speeding up. I was going down an incline. And then I got pulled over for speeding.
Oh,
So I really got to lose money on Lehman. I got a speeding ticket on top of that. So
The
it wasn't a lot
police
of money,
officer didn't let you off. You didn't tell him that, him or her, that you were speeding because you were trying to, make up for your losses, and they didn't care.
I think telling a police officer that you work at Goldman and you should get off for a ticket for that isn't going to help you very much.
You're right there. Okay, so you're there, and it sounds like, are you on the stock research side, like, or are you in the macro side?
I was in
Is
the
this
macro
New York
side.
or London?
I was in New York.
Okay.
On the macro side, working with Jan Hatzius and Dominic Wilson.
Oh, okay. Terrific. And that must have been quite an experience. So then you're there for a few years, and then you get a chance to come back home to Canada. BCA, the fabled institution that's been around. Am I right that it's the longest running macro shop in the world?
It must be. I mean, it was formed in 1949.
Right.
And back then, the Bank Credit Analyst, which is sort of the flagship publication of the firm, was one of the only publications that addressed kind of macroeconomic issues from a financial and investing lens. And of course, back then people didn't even have access to data, right? So if you wanted to see what was happening to the money supply or credit growth, like every week you'd wait for this publication to come in, and there it was. Things are much different now, but we've been around for a long time, sure.
Right. Marco Papic I'm lucky to count him as a friend, and he told us one time the story about the library at the BCA and how much he learned by going and just sitting in the library and reading old versions and just doing it. He said it's one of the best libraries in the world for financial, publications or information.
Yeah, up until recently, we actually had a librarian who kept track of all of these things. Now everything's sort of moved digital now, right. But yeah, we have like this vast reservoir of data, over 1 million data sets, many of which are proprietary, and that ends up being a key input into our research process.
Okay. All right. So let's talk a little bit about markets. And one of the things that I love about you is that I go on the Bloomberg, I type in SPX, Index Go, and I type in A&R, which is the analyst, I guess, what does the N stand for? Recommendations. And then you sort it by target price, and you're the most bearish out there. And I was just watching a video the other day of a podcast that you were on, and they said you're the most bearish. And folks hear your target, and I don't know what it is now, but on the Bloomberg, it's still showing 44.50. And it sounds so preposterous. It sounds so low. And I always tell people, it's actually not that hard to get there. All you need to do is, put a 10% earnings, like slow down. Let's not even call it a recession. Yeah. And then go back to the multiple that we were at in the 2015 to 2020 period, which seems pretty reasonable given that interest rates are much higher today than they were then. And you get to your number really easily. Is that the kind of, have I got the logic right of why you're there?
Yeah. I mean, my earnings forecast for the S&P for 2025 is 250, which is also the lowest on the street. Now, we started the year, I think, at around 270. We're down to around 261, 262 now. If current trends prevail, we could be down to 250, even in the absence of a recession. And then you say, okay, well, what sort of P multiple would you attach to those earnings if we do get the sort of recessionary slowdown that I expect? Let's say you attach 18 times multiple to those earnings, which is actually really generous, because in a typical recession, the P multiple falls into the teens. If it's a mild recession, to the single digits. If it's a deep recession, but I'll just say 18 just for the sake of it. Well, 18 times 250 is 4,500. So it's very easy to envision the market getting down to that level, even in a very mild recessionary slowdown. And I don't think we'll get there if we get a soft landing. So my target is predicated on a recession. I see that as a 60% probability. But if we get one, the market's not at all priced for that outcome.
Okay, let's talk a little bit about this bump that we've had in the multiples, because I think it's interesting. I had a discussion earlier with some guys on my desk, and there was a young guy there, and he's trying to tell me that this time is different and that the stock market deserves this multiple because the large tech and all of the yada, 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 AI, and it's transformational. And, my pushback to him was, it's always different. There's always a reason for it. And yet we as humans seem to do this cycle over and over again in terms of assuming this permanently high plateau, which is what Fisher talked about that in the 30s and the 20s. I mean, before it crashed. What do you think is driving the earnings multiple expansion, and what do you think, absent a recession or a slowdown, might change that multiple that's applied on U.S. stocks?
Yeah, I mean, I think there's some truth to the claim that the growth of tech within the indices does help explain and perhaps even justify a higher P ratio. But if you look at kind of the Magnificent Seven versus the other 493, the Magnificent Seven trade at around 29 times forward earnings. The other 493 trade at 19 and a half times forward earnings, which is lower. But the average between 2015 and 2019 for the 493 other companies was 16. So we're at 19 and a half now. We were at 16 in an environment where there was no recession. We had the tax cuts, for a good span of that period, and still the average P multiple was substantially lower for those non-tech stocks. Now, as far as the Magnificent Seven stocks and other tech stocks are concerned, a lot depends on whether you believe that AI will be the great creator of profits in the way that tech has been able to benefit from other major technologies. I'm not sure if it will be. I think the thing about AI is that right now a lot of these models are very similar. They use the same kind of neural net transformer architectures. They use the same training sets, basically just the corpus of the internet. So they're kind of commoditized already. Now maybe there will be a winner that emerges, but we don't know which one. So you're going to lose money on some of these companies if you invest in them, or there might just be a case where it ends up being a lot like browsers on the internet, or other technologies that just sort of become commoditized. People use them, they benefit from them, but they never make any money. I think with AI, it's actually going to be quite difficult to make money because you don't have kind of these network effects that you have with like social media, where people use a platform because everybody else uses it. With AI, if I use ChatGPT, it doesn't make your experience any better. In fact, it makes it worse because my question slows everything down for others, and that's because unlike say Facebook or Instagram, where adding users is costless. With AI, it actually costs money to add users. You need more data centers, more chips, more electricity. So in many respects, AI actually looks a lot like airlines. You got a commoditized product, you got high capex, high depreciation rates. That's not a recipe for investment success.
Well, that was the famous line that what did Warren Buffett said? If he could go back in time, he could save investors a lot of money by sabotaging the Wright brothers in terms of the first airplane, because it's cost investors so much money. One of the things that I think is interesting is that you mentioned that the amount of capital required, wasn't that the old bullish scenario, or the bullish case for these tech stocks was that they were so light in capital, and now we've gone and turned their biggest strength into one of their biggest weakness.
Yeah, exactly. And so you got companies like Google that are spending billions and billions of dollars on capex, not to create a monopoly position. Google already has a monopoly position. It's to try to defend its existing monopoly position, maybe successfully, maybe unsuccessfully. But yeah, a lot of this capex is sort of defensive. capex, and unless it generates sort of monopoly profits, the old Peter Thiel line, competition is for losers. Like the way you make money in the stock market is by having a huge moat around yourself. Unless your technology lends itself to that, you're not going to make a lot of money.
Right. Now, one of the things that you mentioned is that the PE expansion is a result of AI. And maybe in this last kind of 24, 25 rally that's been the case. But if we remember back to the post-COVID rally, we went into the COVID with the S&P trading roughly 18 times forward earnings, dipped a little, and then coming out of it, we had this situation where we traded up to 22, 24 times forward earnings. I'm wondering, one of the things that I contend is that Fiscal really changed the ball game. It was a dramatic change of the macro environment. And in the old days, when I first started telling people the line about the government's deficit is the private sector's credit, there was a lot of pushback. Now I feel like that's been accepted, and it's almost a reason to buy stocks is to go out and buy it because of the big deficits. I would love your opinion about how that's evolved, whether you agree with that, and whether you think investors have gone from pushing back on that to now accepting it almost too much, which is where I lie.
Yeah, I mean, the situation is a little bit different now than in 2020. Back then we had huge budget deficits, so people were getting all these stimulus checks, some of which they used to splurge on electronics, but some of which they used to play in the stock market, and that helped to drive stocks higher. But the thing is, back then those large budget deficits didn't put a lot of pressure on bond yields,
Right.
because you still had slack in the economy. The Fed didn't have to raise rates. Now I've got big budget deficits and fairly high bond yields, and so it's a different environment now. And remember TINA? There is no alternative.
Right.
People don't talk about TINA anymore because bond yields are not close to zero. So if you look at the equity risk premiums or the earnings yield on stocks versus the bond yields, stocks don't look particularly attractive. In fact, they look less attractive than they did in 2021 because yields are so much higher now.
One of the things about the equity risk premium that I came across this great study from Ruffer, and they showed the equity risk premium and they charted that against the 1 year forward the forward S&P returns. Meaning like they plotted the equity risk premium and then what the S&P returned over the next year. And that relationship was just random. There was almost nothing there.
Yeah.
But then when you plotted the equity risk premium over the forward 10-year S&P return,
Yeah.
it did a great job of explaining it. And so one of the things that I always counsel people when they start talking about those things is that, yes, it doesn't matter over the short run valuation, but over the long run valuation is almost all that matters. Do you feel similarly? And do you worry about like a 5-10 year period when the S&P is going to dramatically underperform other assets?
Yeah, and I think that's true across every asset class, that in the long term, valuations tend to supersede every other consideration. Now, of course, you do need earnings growth, right? So European stocks, Chinese stocks have kind of looked cheap relative to U.S. stocks for a long time, and they haven't really had strong earnings growth. I mean, there's some enthusiasm now around Europe, but let's see whether that actually translates into meaningfully stronger earnings. So yes, you could have justified being really bullish on U.S. stocks based on the fact that earnings growth has been so strong, despite the fact that P multiples have been elevated. But looking out, you better be sure that earnings growth will not only be strong, but will be super strong, just because valuations now are more stretched than they were 5 or 10 years ago. And I'm skeptical that U.S. companies will be able to deliver the sort of earnings growth that would be required to justify these multiples, because profit margins now are at record high. If you look at forward profit margins, so forward earnings divided by forward sales estimates,
Right.
they're at record high levels. They're substantially higher even where they were in 2019. So this isn't some sort of longer term trend. Even cyclically, profit margins are extremely elevated. So if we get any sort of a meaningful economic slowdown, you're going to see pretty dramatic cuts to earnings estimates, I suspect.
So you're not just saying like that the Nvidia isn't overtaking the index and making, because it's such a profitable area and it has such a large market cap, that when you're looking at the index as the whole, those forward margins might be elevated because of Nvidia. But you're saying even the cyclical companies, like the regular ones, like or maybe let's take the median company, is the median trading company trading at elevated forward record profit margins?
Yeah, I mean, you can look at margins across sectors, and what you find is that, yes, they're super high in IT, but they're generally high everywhere else too, perhaps with the exception of energy and healthcare. So margins are high now in the US. And, I believe in capitalism. Capitalism requires competition. I don't think that these profit margins will persist indefinitely. And maybe they don't come down very quickly unless we have a recession, but they're not going to continue to grow. And the thing is, when you look at earnings estimates, they're always like, 10% growth, whereas sales growth is expected to be like 4 or 5%. So implicitly, analysts are always expecting the margins will get higher and higher and higher. There's no kind of law in economics that says that this should be the case. If anything, it's quite the opposite.
Yeah, well, I was going to say, isn't that a feature of capitalism that margins should actually be mean reverting and go back to closer to zero in a perfect competition world?
Yeah, so now we have more monopoly, and that's one reason why margins are higher. And maybe we'll continue to move towards a direction where monopoly power gets greater and greater and greater. But politically, there's going to be pushback to that at some point. So I think as investors, we can't count on it.
And what do you think is driving the investors' belief in these forward margins? Like, do you think that there's something that's changed, or is this just a part of the cycle? Like, I would love just kind of your bigger picture view of how we've gotten here. What were the driving forces that got us to this point where the market was is so optimistic about the expectations?
Well, I mean, the reality is that for many, many years, capital share of income has been growing. Wage growth has not kept up with productivity. And as a consequence, you've had sort of rising income inequality, which has led to more political populism as one of the outcomes. Now, debatable whether the person at the White House now is really going to do much about that. But certainly he talks the talk, and he does so because it's politically sensible to do so, because there is a lot of annoyance about the fact that so many people, especially in the working class, have been left behind. So my guess is that we can't assume that there's going to be kind of this secular increase in corporate profitability. At some point, we're going to see profits come down. And when that happens, it's going to be a huge shock and a very, very unwelcome surprise for investors.
So is it almost your argument that it's a function of globalism? And to your point, if Trump is successful in doing what he says he wants to do, isn't that actually bad for the stock market over the long run?
Well,
in terms of the trade deficit, for example, like I think a lot of people believe that the trade deficit, they can put it to zero and we can have stocks stay at these elevated levels. And I contend that I don't think it can be done. Can I just quote something I grabbed that you said on another podcast? You said, if the U.S. has high unemployment, then a trade deficit would be problematic, but it doesn't. So if you reduce the trade deficit in a full employment economy, all you're going to do is shift workers from high productivity sectors of the economy to low productivity sectors.
Yeah.
Right. Could you explain to people what you mean there and what you think the implications are if Donald Trump were successful, or any politician were successful in reducing the trade deficit?
Yeah, I like to joke that Donald Trump's view of trade is based on critical trade theory, kind of this idea that if you're running trade deficit with another country, it must be because they're discriminating against you. There's no possible other
Right.
explanation. The reality is that the U.S. has large trade deficits because foreigners often prefer to buy U.S. assets rather than U.S. goods and services, because they see the U.S. as an attractive place to invest, or at least they used to see the U.S. as an attractive place to invest. Now, is that a problem? Well, it's only a problem if you have unemployment, because then you want foreigners to be buying more goods and services and generating demand in the process. We don't have high unemployment at the moment, and so if you take steps to reduce the trade deficit, all you're going to do is end up shifting workers who are now working in relatively high wage, high productivity sectors to lower wage, lower productivity sectors where most of the production is currently done abroad. That's not going to result in higher GDP. In fact, quite the opposite. By bringing down productivity, it's going to result in lower GDP with no increase in employment, because you already have something close to full employment right now. So I think this strategy is not particularly sensible. Now, if foreigners were sort of eating the cost of tariffs, then okay. But we're actually not seeing that. Like every month, the U.S. publishes import price indices, which are calculated prior to the imposition of tariffs, with the exception of a few areas like Japanese autos. That's more sort of specific to that particular industry. Japanese automakers never lower prices when the yen weakens, so they've got big fat profit margins. And so now we're sort of absorbing the cost of tariffs. But outside of those few areas, what we're seeing is that U.S. Importers are absorbing those tariffs in the form of lower profit margins. So the question of what's going to happen to corporate profitability. I think the reason they haven't passed on those tariffs to consumers yet is because they're hoping the tariffs go away and they don't want to lose market share, and they certainly don't want to invite a nasty tweet or a true social post, whatever you call it these days, from Donald Trump. But at some point, they're going to have to pass on those tariffs to consumers, or at least try to pass on those tariffs to consumers, and that's going to potentially slow the economy.
So don't we either get inflation or lower margins or some combination of both?
I think it's going to be some combination of both. You're going to have lower margins and you're going to have higher inflation. And by the way, like we have kind of market instruments that kind of give you a sense of where inflation is going. Right now, as we speak, the 12-month CPI swap, so that's sort of a market gauge of where investors think inflation will be in 12 months, it's sitting at around 3.1%. The inflation rate in May was 2.4%. So the market is saying that inflation is going to rise by 0.7 percentage points. Now, it's not huge, but at a time when real incomes are not growing as quickly as they were before, having this additional inflation is only going to make things worse.
Not only that, in the days following the Liberation Day, is that what he called it? That swap had actually almost gone to 4. It traded 3.90, and so the real question is that even correct? It might it be a little lower? But one of the things that I find interesting about that is if you look at the 2-year swap and then you do the 1 year forward, they assume a year from now inflation will be back at 2.5%. Do you think that will be the case, or do you worry that we are sowing the seeds for a much stickier inflation that will be higher than folks expect going forward?
I mean, I was very worried about inflation in 2021 because the labor market was so tight. I'm much less worried about inflation now. I think, there's less ability for companies to pass on higher costs to consumer, and 2, I suspect that underlying wage growth is going to slow, and that will help to sort of keep inflation in check. I'm more worried about recession risk than I am about inflation risk, in other words.
Okay, got it. So you think the market's almost correct in assuming that 1 year forward inflation goes back lower because of the recession risk. So one of the things that you recently wrote about is the beverage curve. Could you explain to people what it is and why you think that it supports your view that worrying about the downside is more something that should be more at the forefront of your mind than the upside risk of inflation.
Yeah. So back in 2022 and 2023, I was one of the most optimistic strategists. And not only was I arguing that the US would avoid a recession, but I was arguing that it would experience this immaculate disinflation where inflation would fall with very little cost to growth. And the basis for that view, which was sort of considered outlandish at that time, because everyone was saying that, of course, we're going to have a recession. The Fed is raising rates in order to kill inflation. But my view was that, wait a second, we've got long-term inflation expectations which are still reasonably well anchored, even if inflation has gone up. And what that means is that we could actually get a benign disinflation. And the way it works, it's actually quite simple. If you think about like a labor supply curve, up until you get to full employment, it's pretty flat. You can keep on adding workers without really having to offer them higher wages. Once you get to full employment, that changes. Once you get to full employment, everyone who wants a job has a job. So the labor supply curve just becomes like a vertical line. You can't expand employment if already everyone who wants to work is working. So what happens at that point is that labor demand goes up. All you get is just higher wage growth. But the opposite is also true. When you're on that steep side of the supply curve and labor demand declines, all that happens is that wage growth goes down, job openings go down, and you can get this very, very benign disinflation. That's what I predicted in 2023. Okay. The problem now is that we've gone all the way down to that kind of kink in the labor supply curve, meaning that if labor demand continues to fall, it's not going to be falling along the steep portion. It's going to be falling along the shallower portion. And that's kind of what the beverage curve is capturing. It's capturing the relationship between job openings on the one hand and the unemployment rate on the other hand. We've had this phase for a few years where labor demand was just bringing down job openings.
Right.
And during that period, people who lost their job, they could just walk across the street and find new work. It wasn't a problem. Unfortunately, now job openings have fallen to such a low level that if they were to fall any further, you wouldn't be able to walk across the street and find new work. You'd be unemployed. You'd be spending less because you'd have less income. Your friends and family would see that you're struggling. They would be saving more for precautionary reasons. And you can very easily get a recession. In other words, that insulation around the labor market that made me optimistic on growth in 2022, 2023, that's gone.
That's a great explanation. Let's talk a little bit about, actually, before we go on to the dollar, let's talk a little bit about today's unemployment report. It ended up being, at least on the surface, stronger than in terms of payrolls, higher than expected. Was that all just kind of a seasonality problem with the winter being a little harsher in a lot of places in the U.S.? So what happened was state labor ended up going a little bit longer, or do you think that this was actually a sign that, the U.S. economy keeps chucking along and there's no real worries there?
Well, I mean, it was a stronger report than I had expected. So I don't like to sort of nitpick these reports and say, this was not good. This was good. Okay, it was an okay report. That being said, let me nitpick a little bit about the data. If you look at what drove payroll growth in June, it was kind of state and local government hiring, and also kind of government adjacent hiring in the education and healthcare areas. Usually in June, there's a big decline in teacher employment because the summer is starting. And so on a non-seasonally adjusted basis, there was a huge fall this month. However, the fall was less than what you normally see. And so on a seasonally adjusted basis, employment in that sector went up. Does that make sense? Probably not. Because if you look at the ADP numbers, they also have a category for teachers and healthcare workers. Their number for June as well shows a decline in employment. And so I suspect that there's just a lot of noise in the data. It's going to be revised away. And by the way, this is sort of a pattern now for payrolls. We get a month's report, and then a couple of months later, we find out that the true number was actually lower. And that is going to continue, by the way, because we're going to get these benchmark revisions for 2024 and first half of 2025 data. We know from the census there's this quarterly census of employment and wages, which the Bureau of Labor Statistics uses to benchmark payrolls. Last year, we know from the census data that payrolls were overstated by around 75,000 per month. So that bias probably continued into this year, which means, just a simple language, when all is said and done, we're going to discover that probably employment growth this year was quite a bit weaker than has been officially published.
And not only that, doesn't, in terms of at turning points, doesn't this often be the case that the first round data, the one that you receive at first, is often then later adjusted and to be in reality much lower? Like I remember in 2007, if you go back and you look at it, even though the payrolls were declining, there was dramatic, like it was like 200,000 they were missing by in terms of when they actually went and counted. So could it be a situation where we're watching something that is inherently too slow and that maybe we should be paying more attention to the weekly unemployment numbers?
Yeah, potentially. I mean, there was this big gap between what was initially reported and what was subsequently reported during the Great Recession. In prior recessions, you didn't see that to the same extent, so it's not clear whether that was specific to that episode or whether it's something more generic. If it's something more generic, then the fact that we are seeing these negative revisions does say that probably the economy is weaker than has been officially reported. So yes, we should look at other data. We should look at initial claims, continuing claims. They're deteriorating, but not dramatically so. So I think probably you can say the labor market is softening, but it's not collapsing. Similar with job openings. The real-time measures, especially from the private sector, such as those from Indeed and LinkUp, they're deteriorating. And that kind of suggests that the labor market is softening, but it hasn't fallen off a cliff yet. The risk, of course, is that these things begin to feed on themselves and then things begin to escalate quite quickly.
Now, as an economist / strategist, you obviously look at the totality of the data and you get a picture from all that. But if I were to say to you, you could only have one economic series to watch over the next year, would it be labor, and which specific labor, or would it be something else? Like, what would you watch to get your best clue of where you think that the market and the economy is headed?
Yeah, I mean, it's hard to choose one. I mean, I think initial claims are reasonably valuable series to look at. Typically, when you enter a recession, you do see claims go up. Now, it's not a perfect series because typically firms stop hiring before they start firing. So by the time they start firing, you're probably already into a recession. But nevertheless, it's going to give you some confirmation that we're in a recession. And the data right now is telling us that we're not in a recession yet. Okay. Doesn't preclude the possibility that we will be in a couple of months, but we're not there yet. Now, having said that, if you look at some of the spending data, it has weakened quite a bit. So for example, if one looks at personal consumption expenditures, so this is just basically U.S. consumer spending, 70% of the economy, so it's a very important series. Real PCE, so inflation-adjusted consumer spending, is actually slightly lower now than it was in December. Now, maybe that was because the Q4 numbers were really strong. We're off a high base. Who knows? But we really haven't had much spending growth on the consumer side so far this year. Likewise, if you look at construction spending, that's been quite weak and only getting weaker, by the way, if you look at building permits and housing starts. Even home prices now are falling. So I would say that on the whole, the economy looks like it's near stall speed. It hasn't entered a recession yet, but the risk of a downturn is still there. Okay.
One of the things I mentioned before I got on this little sidetrack was the dollar. We've fallen a long way. Is this just a slight readjustment of foreigners of the dollar assets they own in terms of increasing their hedge ratio? Or is it the start of a secular bear market in the dollar? that might have further to fall?
So this is, again, where those questions around valuations are very, very useful. If you take the value of the dollar index and you compare that to its so-called purchasing power parity exchange rate. So this is the exchange rate that equalizes the price of a basket of goods and services across countries. It's sort of like the Big Mac index, but for all prices.
Right.
The dollar going into this year was very expensive based on PPP. And it's amazing if you look at kind of the dollar's valuation relative to PPP and subsequent 10-year returns, the two lines overlap very, very closely. A bit like what you said earlier around taking kind of the P ratio and looking at the subsequent 10-year return, get a very high correlation. It's the same with the dollar.
Okay.
So the dollar entered this year very, very expensive. And then you had Liberation Day. And foreigners were like, wait a second, do I really want to hold that many dollars with the U.S. Acting the way it is? And then you had the fiscal process that led to the One Big Beautiful Act, which is probably going to result in budget deficits of 7%, maybe 8%, because a lot of these spending cuts probably will never happen. And foreigners again are saying, well, do I really want to own bonds if U.S. debt is set to continue to rise as a share of GDP for as far as the eye can see? So that reduced demand for U.S. bonds, and that in turn reduced demand for U.S. dollars, and so the value of the dollar declined.
So do you think that explains how we got here? Does it continue? And what are the risks? Like, we've gone from really overpriced in terms of a PPP basis to probably moderately overpriced now. Markets often go from overpriced to underpriced and don't stop in the middle very often at fair value. Are we on the way to the underpriced, or and how long would that take? And does that worry you, or is that not something that's on your radar and you're not that concerned about?
I don't think we're going to have a dollar collapse, but I think the dollar will weaken over time. And so we're talking about next few years or so. I mean, it's similar to what happened between 2001 and 2008. The dollar was kind of in a secular bear market. So I think we've entered another secular bear market. Now, historically, the dollar tends to be somewhat counter-cyclical. So if we do enter a recession, maybe the dollar temporarily stabilizes, perhaps even strengthens. But I think that will sort of be just a pause in a longer term weakening dollar trend.
Does it worry you in that, you mentioned how the dollar is counter-cyclical, and it's like that's the dollar smile in terms of how when things are really good in the US, it rises. And when things are really bad, it also rises because credit is destroyed and people pay back their dollars that they borrowed in. One of the things that we had that was interesting in the post-Liberation Day tradings was a period when both, or actually all three, the US dollar, US stock market, and the US bond market all went down together, which was a very unusual, not very often seen, haven't been seen in decades. Do you think that was something that just, Trump being Trump did some crazy stuff? Some people got nervous. It's not that much to worry about. Market's going to fix itself up. Or do you think that was potentially a sign of a regime change in terms of those correlations that we've counted on, in terms of the negative correlation, in terms of like risk off, dollar up? Has that gone away, and is that a worry for you?
I think it's still a worry. I mean, it was driven by the fact that the market at that time thought that Trump really had become unhinged when it comes to tariffs. And subsequent to that, it seems as though the market has disciplined him, and he sort of walked back some of the tariff hikes. And so the market has gotten a little bit more comfortable. At least the stock market has gotten more comfortable with trade policy. The dollar is still, trying to find a bottom. But yeah, it was quite an interesting episode. Kind of reminded me of my IMF days. It's very EM-like behavior to see.
That's true. That's what some of my buddies are saying. The U.S. has become an EM, and I actually joke and say some of the Brazil and the guys that have been trading EM for a long time, have they been getting a lot of things right, because it actually has become more EM-like in the market reactions to things.
Yeah, and I think there's like, I think what's important, and I don't really know the answer to this question, like whether this is sort of Trump related stuff or whether this is really kind of a trend that the U.S. is on. It kind of reminds me of Thomas Friedman's famous quote during the first Gulf War. He asked, "Is Iraq the way it is because of Saddam Hussein, or is Saddam Hussein the way he is because of Iraq?" You can ask kind of the same question about the U.S. Like, is the U.S. now with all these crazy tariffs just because of Trump, or is Trump just sort of emblematic of where we're going in terms of political populism? I don't know the answer to that question.
That's a great question.
The answer is going to be very, very
Yeah.
important.
It is. All right. In terms of when you go, you must go travel a lot or at least talk to clients from all over the world. I'd love to know what they're thinking and when the questions that they're asking. Is it surprising you? And just any sort of color in terms of your interactions with the clients and especially non-US clients. That's what I'm most interested in.
Yeah, I think there's sort of a bit of a difference between US and non-US. I think in the US, the general view is that everything was fine until Liberation Day. Then Trump went crazy with the tariffs. Then he kind of pulled back. And so now we don't have to really worry too much about tariffs anymore. Rather, we're going to have these beautiful stimulus policies, and everything will be fine. I'm kind of skeptical. I don't think Trump has fully walked back the tariffs, and I don't think everything was fine even before Liberation Day. So there are risks to the economy and the stock market. Outside of the U.S., people are just sort of bewildered by what's going on. They thought that the U.S. was an ally, and just to see how they're being treated. Like they don't say it in public, but they say it in private. There's just a lot of anger towards the U.S. These days, which is why I'm very skeptical we're actually going to get any sort of meaningful trade deals from like the EU, even Japan. They politically can't look as though they're just giving in to Trump that easily, especially the EU. I mean, the EU is a big trading bloc. It's not as though the US has nearly as much power over the EU as Trump believes. So I suspect that these problems will continue to persist. But the good thing, and this is sort of more investment relevant, is that other countries are kind of looking at themselves and saying, okay, we can't be as reliant on the U.S. as we were before, either for growth or for the military protection. We're going to do more of these things ourselves. So here in Canada, of course, we've seen a real push to dismantle interprovincial trade barriers. You can say,
Right.
Why in the world would there be trade barriers between Quebec and Ontario? Well, there are. And now we're sort of bringing them down. We're seeing some of that in Europe as well. And that's going to be one of the positive developments from the trade war, that it's going to force more reform outside of the U.S. as countries look to become more economically resilient.
Peter, since you're a PhD and you're much smarter than me at this, I read stuff about the interprovincial trade barriers, the dismantling of that in Canada has been contributing as much as 1% to GDP. And I just think to myself, I can't believe, like, yeah, okay, I can't buy French, like I can't buy your dairy or whatever, and I can't get Okanagan wines. But is it really 1%? Like, do you buy those numbers that it was impeding our economy as much as they say it was?
Well, I guess it depends on whether we're talking about 1% on GDP growth or 1% on the level of GDP. I think in terms of the level of GDP, the numbers are generally higher, like around 5% or so, maybe up to 10%. But if you kind of ask, like, how long would it take to get the full benefit in terms of higher productivity, it's not going to be 1 year, it might be 10 years. And so you will get faster growth of around 1% per year during that transition phase.
So it is, you believe it is that stifling? Like
I think so.
Oh, you do? Okay.
There's a lot of vested interests that want these restrictions to remain in place. And so what you need is sort of kind of a collective action mover that says, okay, everybody's going to give up these little fiefdoms that they have for their own province, and then everybody will be better off collectively.
I was in London recently, and I was shocked at the how should I say this? I was shocked at, in terms of when I talked to folks about Europe, how determined they are on the same way that we are determined to do these things, and how the attitude has changed. And like even Germany taking off the debt brake and doing things that was previously unheard of. All of a sudden, these things seemed a lot more plausible or even probable. And does this make you bullish on the rest of the world, like versus the U.S.? Like, so are you looking at this going, the U.S. is overpriced, everyone else is cheap, this is kind of a no-brainer to invest outside the U.S.?
I mean, in general, I do favor non-U.S. stocks, but I'm also kind of realistic about what can and will be achieved. So in the case of Europe, Germany can do more stimulus, of course. They've got the fiscal space to do so. But France, Italy, Spain, Belgium, UK, they all have government debt to GDP ratios of above 100%. So they're limited in what they can do. In fact, France is looking to reduce its budget deficit rather than increase it because it's already quite high. So, I think the risk for Europe is that we get something that looks a bit like what happened in the early 1990s, where Germany was also doing a lot of stimulus associated with reunification that pushed up bond yields because the currencies were all pegged at that time. Bond yields in Germany go up, they go up everywhere else, and that actually made life miserable for a lot of other countries, including the UK, which at that time had an exchange rate that was pegged to the Deutschmark. And of course, that's where Soros and Besant made a lot of money. So there's kind of this risk for the other countries that are not able to do a lot of stimulus themselves.
So your argument is or not your argument, the thing that you're suggesting is that if Germany does too much, not too much, but if it does what they say, they're the only ones with real room, rates go up across the board, and actually these other countries start feeling the pain from rates.
Yeah, I mean, it's sort of a kind of standard economic theory that if you have a system of fixed exchange rates in the euro area, you have the same exchange rate, right? That you need to have sort of coordinated fiscal policy for things to make sense. Because if you have one country that's doing a lot of stimulus, another country's doing austerity, you're going to have a situation where the country with the stimulus gets overheated and the other country ends up cooling down too much. It's not an optimal situation.
Doesn't that just mean that we should be buying Germany and forgetting about the other ones?
Yeah, though, I mean, the German stock market is not as levered to German growth as it is to global growth. And the problem in Germany is that German companies are increasingly finding it difficult to compete with Chinese companies because their export mix overlaps quite a bit, and it's becoming increasingly overlapping as China kind of moves up the value chain and ends up competing in those areas that German companies once dominated.
Tell me your opinion on China and where they stand and what the challenges are facing them, and if there's any investment opportunities there.
Yeah, I mean, China looks a lot like it's in the same path as Japan. It's got kind of deep-rooted deflationary pressures now. Producer prices have been falling pretty relentlessly. Home prices are falling now. Housing construction is declining dramatically. In fact, it's already declined a lot. Housing starts are down 70% from their peak. And the problem is that China historically has been very reliant on housing and exports as sources of growth and demand. Exports are being challenged by the trade war. Exports to the US are down 35%. It hasn't actually hurt China yet because China has been able to reorient these exports to other countries. Like Chinese exports to Canada are up 20%. To the EU, they're up 12% year over year. But that's not sustainable. That's not sustainable. I think China's export sector is going to slow. The housing market will continue to slow just because of the demographics. Like China's population is now shrinking. There's already probably 20 million vacant apartments in China. There's just no demand for this property. So they have to do more kind of consumer-focused stimulus. And they're doing some of that now, but it's very kind of begrudgingly done. There's just kind of this ideological roadblock. It's kind of funny for a communist party, officially communist party. They kind of act in a very Germanic Austrian way when it comes to stimulus.
At least Xi does.
Yes,
because before Xi, they were more than happy to save the world in the GFC, doing too much stimulus. I think that is my understanding. I rely on my buddy Louis Vincent Gab for most of this, but my understanding is Xi's kind of always viewed the corruption that kind of was created as the result of that huge stimulus done in the mid 2000s to save the global economy as part of the problem, and that's why he's been so reluctant to repeat it.
Yeah. Well, they've never been that keen on consumer-focused stimulus. So during the GFC, they did stimulus that was focused on the real estate market, and that was fine just because China was still urbanizing very rapidly. There was a lot of demand for housing, so it worked. Then you kind of started to get into excess capacity issues with housing, and they started doing manufacturing-focused stimulus, infrastructure-focused stimulus, and that worked for a while, but then you ran into excess capacity in manufacturing and in infrastructure, and now what do? The only thing you can really do is consumer-focused stimulus, and you're right, Xi is just very averse to that. He sees that kind of consumer-focused stimulus as the providence of the decadent West, and he doesn't want China to be doing it.
So I've asked you a lot of questions, Peter. If you were to put yourself in my shoes, like, what did I miss? What question should I have asked Peter that I have missed?
That's a good question. I mean, I think, we didn't talk very much about commodities and gold, things like that. I'm actually still quite bullish on gold. I think that we're in the midst of a secular bull market in gold. And yes, the price of gold is high. But if you look at the value of gold in relation to the value of all other assets, it's actually much lower now than it was in the early 1980s when gold prices were similarly high in real terms, because global wealth has grown so much over that period. And I think you can make a case that the value of gold should sort of increase in line with overall wealth. If that's the benchmark, then gold prices still have quite a bit of upside.
Is part of your bull market or the bull forecast on gold the result of the Russia situation in 2022 when they invaded Ukraine and they were zeroed on their FX reserves, and the fact is that central banks have been driving it, or is that not as important to you? You're more interested in this idea that it just should represent a certain percentage of the world's wealth?
Well, I think it's both.
It's both.
The fact is that we do have tailwinds from geopolitics. Like if you look at Chinese holdings of gold, the PBOC's holdings have gone from 1% of assets to 5%, but I think you can easily go to 10%, and that's true for other central banks as well. And realistically, like we talked about the U.S. fiscal situation a little bit earlier, if you were on a course in the U.S. to 8% of GDP budget deficits in a full employment economy,
non-wartime, non-recession, crazy.
Absolutely crazy. And and so what's the alternative? I mean, Bitcoin is an alternative, I suppose, but gold is also a good alternative.
Are you amazed that folks have accepted this 8% or 7%, whatever the number is, so easily? Because I am. I'm just flabbergasted that we've gone. And let's remember, it wasn't that long ago that Scott Besson was telling us the 3-3-3, and everyone on Wall Street was telling me how they're going to cut and they're going to go to 3%. And then just overnight, he's like, no, we're not going to cut. We're going to actually do this, and it's going to be 7%. But don't worry, the growth's all going to come on the other side. It is madness.
Yeah, and there seems to be sort of a bipartisan consensus not to really do much to rein in the deficits. The Republicans can't fathom the idea of raising taxes, and the Democrats can't fathom the idea of cutting spending, at least not on social programs. So I think we know that this is not sustainable. We don't know when things get so tough that hard choices will have to be made. And certainly talking about the U.S. fiscal situation does resemble a little bit that story about the boy who cried wolf. People have been talking about it for years. But of course, in that story, the kid did get eaten at the end, right? We just don't know when that'll happen.
Well, this is what kind of makes me mad. I hear Steve Eisman from The Big Short fame talking about that. And he says, like, 20 years ago, if you had taken me aside and asked me about the deficit, I would have told you that there's nothing to be worried about. In the next 20 years, we've had like this terrific experience in the US. And I kind of call bullshit on that, because I'm thinking to myself, 20 years ago, you probably would have been worried about the deficit. It's only now, and it's kind of like everyone's accepted that now we don't need to worry about the deficit. And it's almost like this acceptance that we don't need to worry about the deficit is almost what's going to create the environment and the necessary preconditions to have the problem.
Exactly.
Anyways, one question for you on this in terms of it. Is it the bond market that like Bill Fleckenstein once said, that they will continue deficit spending until the bond markets takes away the keys? Is that the what's going to stop it, and what does that look like?
Yeah, so I think it will be the bond market. The question is whether it's done in the midst of a crisis, or whether it's sort of more of a slow pressure that eventually leads to political change. And I think most people think, well, it would require a crisis. Maybe, but there are alternatives. And Canada actually presents an alternative. Like, we think of what happened to Canada in the early 1990s. We had very high deficits. Inflation was rising. We had a few failed auctions. And then
did we have failed auctions? I didn't know that part of it.
Yeah. There were auctions that went very poorly, let's put it that way. And so what happened? We actually had kind of proactive fiscal tightening. We had the GST, and the budget deficit got lower. We never had a crisis. We did have a recession. The recession in the early 1990s was a very, very painful recession, much worse than what the U.S. experienced. But we never had a formal crisis in the way that Greece or Italy did. So there is a possibility that cooler heads prevail, but there's also a possibility that we actually do get an outright crisis. Bond yields go up, and then all of a sudden people are calling their wealth manager and saying, why do you own bonds? Are you stupid? Don't you realize how big the deficit is? Right. Get me out. And that sort of feeds on itself. That's also a real risk.
In terms of Canada, though, it was lucky we're a small nation and we were able to basically let it all be the dollar. Like, the Canadian dollar went way down, so we could steal growth from other folks. The trouble about the U.S. is they're the world's reserve currency. You can't steal growth from everyone else. It's going to be a disaster. Okay, let's finish it off with a question. One of the things that I'm going to steal an old one that I used to use, and this is actually from the O'Shaughnessy podcast, and he liked to end this podcast with asking the interviewee if there was a period in their life where someone did something extraordinarily kind for them in their career that they remember, and if they were comfortable sharing it. In terms of someone that was important to you that did something, and I'm springing this on you, so I'm going to keep talking to give you a little bit of time to think about something, but something very kind, like a point in your career when you were developed. Is there a story that you wouldn't mind sharing?
That's a good question. My first recollection was a teacher that I had in high school, Mr. Schlechter, I think.
Okay.
He was the history teacher. And I was a good student in high school, but as a teenage boy, I wasn't that studious. And he always kind of focused on thinking about the big picture, the big ideas. Like, don't tell me facts. This happened on such a date. I don't care about that. I don't care about history facts. Tell me the concept. Tell me the idea. Think through the history rather than just memorizing a bunch of facts. That actually had a real important effect on me, not just when it comes to the history class, but even things like math. I was never particularly interested in math because I was just trying to memorize the equations. And then I started thinking to myself, I'm going to understand the concepts.
Right.
And when I did that, all of a sudden things got so much more interesting to me, and I started doing a lot better in my classes than I had before, and that kind of allowed me to kind of pursue a good education and get a good job with the IMF and Goldman. So I'm very, I never thanked them. I don't know if he's still alive, but
Well, there you go.
in retrospect, that had a big effect on me.
Well, and we'll thank all the teachers out there that are doing wonderful things. And that's a great story because it just goes to show you how a very small thing can make a big difference in a person's life. And that's a great story. So thank you for sharing it. Before we leave, let's give you a chance to talk about your firm. I mentioned BCA as being one of the bedrocks of macroeconomics, and now you got Marco Papich. We're gonna have to call him that from now on. Macro Papich. Marco's come back to your shop. Why don't you tell people a little bit more about it? Where, who it's for, where they can reach out to get information, and like how they can go about contacting you guys.
Yeah, I mean, BCA Research is the world's largest provider of independent macro research. And I stress the word independent. We're not a broker. We're not an investment bank. We only do macro research. And sometimes we'll be right, sometimes we'll be wrong, but it's always honest. It's always aimed to be as objective as possible because we don't have any conflicts of interest. I'm the firm's chief global strategist. Matt Gherkin does geopolitics. Mark also kind of does geo-macro, synthesizing macroeconomics and political developments. But we have people that are focused on bonds, on FX, on U.S. Sectors. And so we all talk to each other. We communicate with another. We collaborate with each other. And as a result, I think we can do research that's really good and really valuable. And I think we estimate that something close to like 85% of the world's top financial companies are BCA clients. Wow. Getting a research for a long time and they enjoy it.
Well, there we go. The last 15 you're holding out. Give the folks at BCA a call and get more of this terrific stuff. So, Peter, it was a pleasure getting to know you. You're in Montreal, right?
That's right. Montreal.
Yeah. So, is you going to go off to Memphremagog, and are you in Eastern Townships or Northern, the Laurentians kind of guy?
Yeah, I have some places around, but
some places. Okay. well, it'll remain a mystery which one, whether you're Eastern Townships or Northern Laurentians. I am a big fan of your town. It's terrific. I want to thank you so much for coming on. It's been a real pleasure getting to know you, and I really appreciate your time.
Thank you so much.
All right, Patrick, what do you got for us for talking charts?
Listen, let's just start off talking about the jobs numbers that came out here on Thursday. First of all, Wednesday, the ADP non-farm employment change came out, and it was the first negative print, minus 33,000, that we saw in years. I have the chart up here, and so this number has been weakening, and it had a lot of anxiety built up that this was going to be the month that the jobs numbers were going to break. And so when we look at the non-farm employment change, last month it was 144,000. The forecasted average expectation was 111,000. Everyone was expecting this number to be a miss and to decline, and it came in line with last month, 147,000. So it just wasn't the decline that everyone was expecting. And then the unemployment rate, which they expected to rise from 4.2 to 4.3%, came in at 4.1%. And so the market simply did not get the bearish confirmation that somehow the economy was weakening, at least not from these jobs numbers. What did you take away from this?
Well, looking at kind of the headline numbers, you're absolutely correct that the market took it as this is a positive number. I was intrigued by actually Jeff Rosenberg, I think, from BlackRock. He was on Bloomberg right afterwards, and he highlighted the fact that although we had a beat in terms of total farm payroll, non-farm payrolls, a lot of it was in the government sector, and it wasn't government, the federal government, but on the statewide level. And so we saw this uptick there. And he just wondered if it was seasonally adjusting problems and that it wasn't as strong as the economy might indicate. And that if we look at the private sector jobs, which actually came in below expectations, that's actually a more clear sign of what's happening in the labor market. I don't know. Lots of things going on, Patrick. We have also the fact that we have, with the crackdown on immigration in the U.S., all sorts of just weird undercurrents. I think the data is difficult to get your hands around on what's really happening on the ground.
There you go. So I want to go to this next chart, which is I started getting hooked here on checking out poly markets ever since we were using it for looking at the odds of the presidential victories. And so they have on poly markets and the betting markets the odds of a U.S. recession in 2025. And during that Liberation Day shit show, the odds were over 60%. That we were going into a recession in 2025. And this thing has just since then been nosediving. And this jobs number had to drop from like 26% now down to like 20% chance of a recession. So at least from a betting markets perspective, the odds of a recession this year are being pulled right out of this market. Do you think that everyone is being too optimistic here, or is this reflective of the fact that simply there is only 6 more months left in the year? They're just the odds that the ugly side rears its head may now be just pushed forward into 2026. What's your take?
Well, I think, Patrick, the market is correct in realizing that the U.S. economy is stronger than everyone expects. It's not rolling over in terms of the imminent doom that people were talking about with the tariffs and the uncertainty created from that. And in fact, you might argue that once we get through this period where the U.S. finally just assigns everyone their tariff number and we get the big, beautiful bill, whether you want to call it that or not, whatever the bill put through, a lot of what should we call it, uncertainty regarding the economy might dissipate, and we could see a situation where the economy strengthens into the fall. I don't know. That's not my base case, but I could understand that argument. The reality is, though, that the Fed keeps saying it, and I think we all need to be data dependent, that you don't know what's happening. There's a lot of uncertainty out there. And until you see signs either way, then there's no point in worrying about it too much. When the economy rolls over, it'll roll over. Until then, the death, what's that line about the reports about my death are premature? That's basically the recession of 2025.
There you go. I like that. All right. Well, let's talk some charts because when everyone was expecting this jobs numbers to come in weak, when they didn't get it, the stock market got just that extra gas in the tank for one more push, and we're up 50 S&P points now above 6,300 on this S&P. One of my big things was I was anticipating those previous highs to at least act like overhead resistance for a brief period of time, but this market ripped like a hot knife through butter right through that previous high, and it's been relentlessly rising. Now, you have talked about it, and Charlie as well, about flows, particularly driven by vol targeting funds coming into play over the course of this month. But this is, I think, only exacerbating the fact that now everyone's on a chase. Everyone, was being somewhat defensively positioned, and the feel of getting into this market while it's ripping, it really feels like right now everyone's just going all in on this.
You think so? Like, you think people are like? I'm not sure I agree as much. People are feeling the pain, and they are no doubt giving up on their negative postures. But I don't get this sense, especially maybe it's the difference between retail and institutions, because I don't get the sense that the institutions are climbing all back aboard and that they're expecting the market to rip. They are aware that it's going without them, and they are rightfully putting risk back on, but I don't feel like that they're optimistic about the future. I actually think that's more of a retail thing.
Well, I guess you're right. It would be a retail thing to those people that were basically expecting this to turn negative, have no choice but to.
Well, and listen, I actually don't want to slam retail in any way, because first of all, I think they got it more right than the institutions did.
Because they were.
And there's this great chart from Bank of America that shows what happened during this last Liberation Day sell-off, and it was very clear that the institutions were the ones selling and that retail bought. And retail just continues to buy and buy and buy. And I guess they are more euphoric. I will say that the amount of speculation you're seeing in some crazy little crappy names, like the SPACs are back. I see Tom Lee's, Ethereum holding company is trading like some ungodly number. So it really does feel frothy that way, but I don't want to slag retail because they've been right and institutions have been wrong.
Right.
Here we are at all-time highs. And was the correct bet to sell into that Liberation Day panic, or was it to buy? And they bought and they were correct. And here we are.
From a measured move perspective, just by looking at rules of symmetry, this having an upside towards 64 to 6,600 at this point is a natural measured move, and so at this stage, this thing tacking on an extra 5% isn't out of line. The part that is actually very interesting was just how short-term overbought we are. Now, you could use things like an RSI indicator or something to indicate overbought and oversold conditions, but I always look at the distance from a 50-day moving average as a benchmark of kind of how extended any short-term move in the market is. The fact is that the S&P rarely trades 300 S&P points above its 50-day moving average. Like, for instance, during bull markets like this, it usually follows a steady rise, which is usually 100 to 200 S&P points above its 50-day moving average during moves. And usually when the distance gets too far away from that moving average, usually it's when a market correction tends to ensue. We're now 300 points more than 300 points above the 50-day moving average, which is not frequently seen. And this is where, while the market has got a very positive momentum, the question is it due for just a pause? And that's not a bear call. It's not a short opportunity, but rather simply at some point, every rally gets checked and there's a little bit of profit taking that kicks in. Are we going to see a period where this thing can spend a week backfilling? Maybe it's going to be wrapped around that July 9th kind of trade deal deadline. And maybe that could trigger some sort of short-term profit taking. What's your thought there?
Well, I actually don't think the July 9th is going to be a big deal. I don't think the market cares as much about trade deals as it used to. I think it's assumed that we're going to get some sort of some countries will do deals, some won't. We're going to end up, somewhere between 10 and 20%. I think the market's accepted that. What I think will be more interesting, Patrick, is the earnings going forward.
Right.
And what those come in at, and do they end up surprising or causing any sort of dislocations? But having, you mentioned Charlie McGilligan and his vol control, and I recently came up with a study that I did with my new buddy Macro Manveer, and it was a new model that was basically looking at that vol control fund and really trying to measure on a day-to-day basis the future flows if we continue to be this sort of subdued realized volatility environment. And one of the things that became very clear to me was we still have another month of that fund, those strategies continuing to bid for the market. And this was a very unique period because the volatility from the Liberation Day was so violent on the downside, but also the upside, Patrick. And that's an important part that we need to realize. Usually what happens is you get some bad news in the market goes down, it becomes more volatile, and then things kind of settle down at a new level. And as it becomes less volatile, the realized numbers start declining, the realized volatility numbers start declining, and then the vol control funds start buying back into the market. In this case, because the snapback was so large, that
this entire period was such a pronounced, still high vol period.
Correct. And usually you don't get as much of a high vol period on the rally, or at least not as long as that rally was. And therefore the vol control funds really took their time and weren't able to get into the market until now, or in the last few weeks or maybe a month. But that bid is there, and it's going to be tough. And if we have a summer situation where it's just kind of quiet, I think that they're going to play a bigger role than folks think. And even this past week, when everyone is being confused about the grind higher, I've been saying, no, the vol control funds are there. That's what's going to happen.
While I fully respect it, and I've even talked about the vol control funds because you inspired me to kind of explore that. I don't think that you can conclude, though, that every single day will be green for the entire month just because they're that. The point I'm making
that at all.
is that we could easily have one of these 3-4 day give backs on the market that ends up being 100, 150 S&P points, and then it goes back up. And the vol funds throughout that whole period are doing their buying, but they may actually allow the sell-off to be far less because they're bidding throughout that period. And so while the sell-off could have been a 300.5% correction, it might only end up being 150 points because of the additional buying supplied by these vol control funds buffers that downside. But I still think that downside corrections are still going to be there because it's just the natural ebb and flow movement of the markets. Yeah. But I want to move on.
One second before you finish there. Can I just make a quick comment? Because I completely agree with that analysis. That is a great way of looking at it. And that's one of the things that people get frustrated on. They'll say, like, we'll get a sell-off, and they'll say, but you said the vol control funds were buying. And the reality is they were buying, but they cushioned it. And that is your point. And I agree with you 100% there. That's a great way of articulating it. But my point
means
is
the sell-offs won't be that deep.
Well, not just that though. This is my point that I kind of wanted to emphasize. Absent anything else occurring, let's just imagine that without vol control funds, we would have had just a regular summer market where it just goes sideways for a month. That is, I think, going to be looking more like what we've experienced in the last week with just a grind. And that's where I'm differing a little. If we don't get bad news, and if we just get something where in the past we would have gone sideways, it's going to grind higher. So just like you say, vol control funds will cushion a negative market. I would argue also vol control funds are going to make a neutral market a positive one, a slight positive one with a grind higher.
There you go. So I want to go a little off course because normally we'd go currencies and commodities and all these different things. I want to go a little bit deeper because I thought something really interesting happened in the markets on July 1st. So at the end of a quarter comes usually the fund rebalancings, right? Quarterly rebalancings. And so watching at these kind of key quarters, what happens is always interesting. And so what we saw happen on July 1st was, in this case, this is the momentum over value ratio. And what we first of all can see is momentum and all these AI stocks and everything were what led the market higher off of that April low. Like we just had this kind of group of stocks, all these momentum names really driving that advance. And what we had here for the first time in a while, even on an up day like today, you have a scenario where momentum is underperforming value. on that. And that was particularly interesting because there were these extraordinary breakouts that were happening on a whole array of sectors that were left for dead. I'm just going to pick on, for instance, ITB, like the home builders. The home builders have been in this vicious, like half year bear market, even longer, like a 9-month bear market decline. They started basing, and they started the month with this nice big breakout candle, breaking it out of a 2-month range, right? Then you see like this happening on healthcare names. I'm just going to pick on Pfizer as an example in the healthcare, but you have suddenly this big breakout candle in many of these healthcare names, like or let's say Biogen, the biotechs, which were left behind, had breakouts all in there. It was interesting, but there was a whole bunch of activity happening where a lot of these beaten down sectors, healthcare, consumer staples, these home builders, all of these sectors suddenly all upticked on this. And now one day doesn't make a new trend. And I don't want to already like say that this is therefore a guarantee, but wouldn't it be interesting is that, like, for instance, there was a huge amount of articles written, not a huge amount, a few of within, the circles of the kind of more institutional side, talking about the breadth of this market being so incredibly narrow, right? Like that this breadth was very narrow, very few leadership. What if the story for the summer is sector rotation? What if we see that the market breadth widens? The S&P may not actually have too much momentum on the upside, still upwards, but it's happening because the breadth of the market is widening. All these sectors that were left behind suddenly start being bid, and we see rotation out of some and profit taking being occurring on some of these areas where people have made a very large amount of money in the last quarter. What's your thinking on that thesis?
I think it's hilarious because didn't we used to argue about this like a year ago, 2 years ago?
We argued about it for the last 5 years, dude.
Yeah,
like
you always were. Whenever I would try to say they would become the other ones, and then listen, you've been right, because the reality is it's just gone narrower and narrower, and anybody that's like tried to go out and buy anything but Mag 7 or the Nifty 50 or, oh, by the way, did you see the Cotu 40?
No.
The Cotu Fantastic 40. Google it. You're going to like those names. They're really high quality, very cheap names. So I guess I would say, Patrick, that maybe you're correct in that. Could that be the market deciding or wondering if the economy is going to be stronger than everyone expects? And could this be a function?
But why would it be defensive sectors though? Like
I think. Well, listen. First of all, I think what actually
stuff
happened. You've highlighted a few things, but if you look at it from a factor point of view, yes, value went up, momentum went down, but it was also looked like it was a big reach for the 12-month losers. It was the stocks that have been down the most.
Yes. Well, that's a lot of the ones I'm highlighting here.
Right.
Right. But I mean, that is still distributing into the wider breadth. But would that not be a defensive play? Like if you're up 30% on a stock in the last 2 months, 3 months, and this thing is trading at 52-week highs, isn't there a certain degree of defensiveness by reallocating to a high value stock that's beaten down at 12-month lows? You kind of force yourself to keep the profits while staying invested. It's kind of a way of rejigging the payoff profile of your portfolio.
Yeah. To me, the real question was that a function of one big, huge whale coming out and rebalancing their portfolio, or is that what the market as a whole wanted to do?
No,
I don't know the answer to that.
What I would say is that it's a combination of both, in a sense that it starts with a whale and then all the technical signals start flashing buy signals on all these things, and then the retail follow the leader.
Well, not just retail. I think it's going to be momentum, because the momentum will change, right? Like, because the reality is momentum will change. I don't know though, Patrick. It just felt like a one-day affair. The next day was less pronounced. Like today, or Thursday, I feel like it could fade. I'm not as sure as you are that it's the start.
No, there's not about sure. Yeah. So I always say to my members, one day does not make a new trend, and therefore there's no way that I want to, just based on 1 or 2 days of price action, conclude that this is fact. But it is something you need to pay attention to, because if it develops into a trend, many of these stocks that have been 50, 60, 70% off of their highs, if they engage into new bull trends, the upside in my mind is far greater than chasing the next incremental high on some of these mags that have already had huge runs. And so like for instance, just using Biogen as an example, if all Biogen did, and then just because I had it up here, did a 50% retracement of its loss and made a run to 175 on the upside, that would be a trough to peak rally of 57%. 57% from trough to peak.
Yeah, like, so you're not going to get that in NVIDIA again.
You're not going to get 57% in NVIDIA. The point is that watch it exactly. Like, just because we both agreed, it's that NVIDIA's the go. But the point being is that a lot of these beaten down names actually have, in some degree, some alpha. Like, because just they've been so beaten down that even if they just recover half of their losses, the percentage gain potential there is far exceeds the next incremental gain on Microsoft. And so this is why I think it's going to be really interesting to see. But know what also is interesting about this is that this spilled over into the resource space. And a lot of the resource stocks that were left for dead all suddenly upticked. Let's just take iron ore. Iron ore was an absolutely hated space. Nobody wanted to touch it with a 10-foot pole. And let's just start with the big boy, BHP Billiton. But like, look at the way BHP gaps higher here, like turning off of that low. Look at the way Vale ripped up to a fresh high. Look at the way Rio upticked. And that's just one example of that. Like, for instance, look at lithium plays like it's ABL, right? What's Albemarle? ALB? Yeah, there you go. But look at the way it off of its lows upticked. Look at the way Alcoa upticked off of that trade range. Suddenly, you have the part of the, because like uranium's been super hot, gold has been super hot. There's a whole series of these kind of niche little pockets that have been huge bull markets. And then there's all these commodity stocks that were literally left for dead. And suddenly it feels like they're waking up. At least there's a few upticks here to find out whether or not something bigger is happening. Like, just taking a broader commodity basket like the DJP, right? The DJP is the Bloomberg Commodity Index. It obviously got hammered when oil got hit after the Iran de-escalation, but then it's upticking. But then take GNR, which is the Global Natural Resource ETF, which is a broad basket of resource names. Look at the way it broke out to a fresh new high. That chart actually looks good all of a sudden.
What is that one?
GNR. Yeah, like Guns N' Roses. GNR. Like
wait, I don't know this. What is this? This is
it's just a big, broad, diversified natural resource ETF. So just
they own the companies, right?
Yeah. Individual companies. So it's just a diversified way. It has a shitty options chain, but you know what? It's just a good way of kind of gauging what the entire space of resource stocks are doing.
Because it trades. It's got a whole bunch of non-US names in there.
Yeah.
Oh, that's great.
right?
Oh,
But the point
I
is,
had no
though,
idea.
but
Thanks,
look at the
Patrick.
way, no worries, but look at the way it upticked, right? Like it actually looks like a breakout, like a full on, like there's a commodity bull market going. Anyway, the point is that there's this whole sector of commodities that was left for dead and quiet, and maybe, just maybe, they're waking up. And
Welcome to the jungle, baby. Couldn't resist.
Nonetheless, that was thing, and it's it'll be really interesting to see whether or not, and even like take something like energy. Let's use the XOP, right? Like energy is hated, oil is hated, but yet it's getting above its 50-day, higher highs, higher lows. Every single pullback holds the Fibonacci zones. Are we quietly seeing money being allocated into the beaten down energy space? It's certainly interesting.
You're a wise man, Charlie Brown. I like it.
There you go.
Hey, what do you got else for you? What other wisdom? What other pearls of wisdom do you have to share with us?
Well, what's interesting here, like gold bounced off its 50-day moving average. Let's just kind of go through a bunch of these broader commodities. But the bounce hasn't really had any gusto behind it here. To me, gold needs to clear 3,400 now with a proper breakout on the upside in order to really solidify a resumption in bull trend. And at that stage, this thing, proceeding to do like another measured move up to 3,600 or something like that would be entirely reasonable. But it really needs to follow through off of this. If it doesn't, has the short-term run in gold finished? I don't want to make that call yet. I want to give the bulls the benefit of the doubt that this retest of the 50-day and that retracement zone is a buy on dip. We're going to watch to see whether this follows through. But I'll tell you right now, if a week passes and this thing hasn't cleared 3,400, it'll make me nervous.
You guys don't want to see Patrick nervous.
You do not want to see me nervous. It's sell. No, but it is. It'll be interesting. By the way, the one other alternative asset like that is breaking out is Bitcoin.
Oh God.
I know. Okay, old side. Like I'm a no coiner too, Kev. But I mean, let's just do some technical chart talking. All right. The point here is that it zigzagged in a very classic flagging formation, and we're literally trading into these major highs. And all I'm observing here is that if Bitcoin manages to make a 52-week high here, the measured moves are all the way to 120 to 130 on the upside. And it's going to be very interesting to see whether crypto is coming back to life here for a bull breakout. Certainly, this is a very key overhead resistance level that needs to be watched. The other one, going back to precious metals, silver. Silver is behaving way better than gold. And what you can observe here is that this little sideways consolidation didn't have anywhere near the depth of pullback that gold did in terms of just relative to the magnitude of its prior rise. And here, silver is attempting a breakout to a fresh new high. If it does, it's targeting $39.40 on the upside. The interesting part, and it's a thought that I'm trying to reconcile in my head, and you can kind of pine in on it. Can silver run without gold?
Yes.
Okay.
It
gold can
went without silver.
It's true.
Right?
It's true.
They're different.
Silver's chart looks better than gold.
Well, there you go. Switch into silver, folks.
Yeah.
The guru has spoken.
You have no comments on any of this.
Well, the last one was Bitcoin. You know me, I'm not going to say anything about that.
All right,
get myself into trouble. Silver, I don't know. The trouble about a lot of these things, Patrick, is it's summer. A lot of people are gone. I'm nervous about things like some of these quotes are going to get jerked around. I don't know. I guess my gut tells me
What if it's
that
the opposite? What if that low volume is what allows them to run it?
right. Well, listen, my gut is that the commodities are to be bought. You know me, I believe that the global economy is stronger than most people expect. And that's why these commodities are starting to go. And therefore you're singing my tune. Like, you're talking about oil being better bid. You're talking about copper, silver, whatever. I like them all. I think that they're all going to do well. And that the global economy, the rest of the world has woken up and has started to spend. And therefore I think that the story is that a lot of things are going to go up.
So let's jump to oil, because obviously when we recorded last time, we were in the midst of a pretty significant escalation in oil. Had that massive short squeeze to the upside that me and you talked about.
Right. And by the way, I realized I goochered it.
Why?
Because I congratulated you on that trade.
Why? I took profits at the top.
Good for you, man. Good
Like,
for you. When the moment I said
me.
Congratulations, by the way, for folks who don't know, the worst thing you can do to a trader is to congratulate them on a trade
before they sold.
Yeah, because
you don't
you have
that.
to
you don't.
So on our desk,
ever.
if you congratulate someone, you're like, oh, you dick, and then we have to take it off because that's the moment it's going to turn. And it was exactly this.
It's the greatest disrespect you could show another trader.
Yeah, never congratulate them. Sorry, I take that back.
No, you can only congratulate them after they've sold.
Okay. Well, I was smart. I didn't know your position.
No, but
you had sold it.
Because my original thesis was it was going to be a short squeeze, and I was looking for something into the mid 70s, and so when I got it, I had to act.
Good for you.
But also the asymmetry of it was kind of
actually skewed. I remember you telling us that. Yeah, I remember you saying
right, like, and so, but now this is an interesting moment because if you're buying down here at 64, 65, 66, to me, the asymmetry now is back in your favor. Why? In the situation where it's very clear that the situation between Iran and Israel, let's just call it the Middle East, the Middle Eastern situation is not really de-escalating. Even though we haven't seen a huge escalation, there isn't I don't think suddenly things get better there. And so there has to be some premium put into oil based on the unfolding circumstances. And the second thing is that, like, so when with the economy being where it is and that premium having to somewhat be in there, is this a scenario where we could see oil drop back down here to its previous lows down at 55? Well, listen, anything can happen, but to me, I don't assign a high probability to this. I think that the likelihood that we retest 55 is just not something I want to give more than an outlier chance of happening. And so at the same time, oil spent a better part of like 6-7 months in a very distinct trade range between 67 and 78 bucks, a $10 range that defined a prolonged period of time. Is it more realistic that oil re-enters the trade ranges it had from September through March versus that of the lows where it was at a couple months ago? And so to me, now that we've gotten the dip, the asymmetry is back. Like right now, being long on the idea that oil can regain into this trade range will allow energy stocks to be bid and things to start turning up. I think that this is a great time to be long energy again.
Patrick, man, just the pearls of wisdom just keep coming from you, buddy. Love it.
Okay, you're making me blush.
No, I'm not making fun of you. I have no comments. I can't add anything to that. It's great analysis. My only question is, what happens on the other podcast? You guys talking about oil yet? Or is it still uranium?
Oh, uranium is still talked about.
Good. So you know what? You're going to be okay. Oil's going higher until we go, and that's the major focus.
There you go. Well, I mean, that's Now that's always at a bull market peak, and so that would be like a year from now or 2 years
Yeah.
from now.
And
Like
you guys go
that's
back to
yeah,
talking.
yeah, yeah. That's not a week in and week out or month in month out thing. That's a much more cyclical thing. We'll talk. Actually, let's talk uranium in a second. But
You figured you don't talk about it enough on the other podcast. You got to bring it in here.
yeah, absolutely. But what actually let's talk about the fact that like I'm starting to sour on just the relentless rise that these things have. I have traded Cameco for 20 years.
Yep.
And I have seen the boom bust cycles the stock goes through. And there is nothing that has dynamically really changed between April to June here. A couple little headlines, but this really is investor euphoria and chasing momentum. And to me, these things mean revert. And it doesn't have to go all the way back to its lows, but at some point, a $10 to $20 pullback on Cameco is par for the course.
Now I know why you wanted to talk about uranium here. You're not allowed to talk about it negatively on the other show. Okay, so that's fine. Let's talk about uranium. You're looking for a correction.
Not a correction. I'm saying that to me, the asymmetry of pressing uranium long is bad because, like, for instance, the risk of a pullback could easily be a $10 to $15 pullback. And so the question is there more than $10 to $15 further upside on Cameco from here? While Cameco can easily go to 80 and it's still in a bull trend, it's still a primary thing. I'm not calling that today is the day when uranium is going to peak and turn, but it's about the fact that you have a diminished payoff profile in continuing to press this trade. And so to me, if I was in kind of put it in a context, I would say I would be underweight these uranium names here.
There you go. Last time you told us that, crude collapsed. I also like the little play on words when you said you're getting sour on them. The energy traders would like that. Well done.
Oh my God. All right. But you know what? The interesting part though be for me, Kev, is that could we see a scenario where uranium stocks correct, but the U308 continues to do fine? Like where
For
like
sure, because the U308 was, again, U308 went down, or at least the spot U308 went down while the stocks were going up. So we could very easily get that relationship flipping back, and you have Cameco and the rest of them going down, and then meanwhile the spot or whatever they call it, or the U.UN rising.
I feel that if you're going to be loaded up on uranium, owning the spot is better at this point than continue to chase the equities.
Okay,
That's
right.
That's kind of my spidey senses thinking of what's going on. By the way, copper had a great run. I think that it's going to stall out at its previous highs. It doesn't mean that I think it's bearish or that it's going to start a new downtrend, but a number of these different measured moves all measure out to its previous high, and we're basically also running up toward there. The interesting part is I'm not so sure that that's going to impact copper stocks as much, but at least if you're trading the actual future, expecting overhead resistance, I think is a good base case to be expecting that. But like a lot of the copper stocks, I'm going to use the COPEX, which is the copper ETF. I mean, it's running. It's going to start running into some previous highs. It's been a really good run up until now, but it's hard to say that this is a good entry for new copper plays, at least on the short term. Like at some point, there'll be a buy on dip opportunity that will probably emerge here. That probably is going to be a little bit better.
Okay, what else you got for us?
You know what? Okay, let's change streams. Let's walk away from commodities for a little bit, And I want to briefly talk about healthcare, and then we'll start wrapping things up. I want to talk the XLV for a second, just the healthcare basket as an aggregate. But more or less, the healthcare's peaked a couple months before the elections, as everyone realized that Robert Kennedy was going to come in with the Maha stuff, and more or less that a lot of these pharmaceutical stocks were going to be in the crosshairs of a lot of these politicians as they're going. And it pretty much spurred on what has been almost a 1 year long bear decline in healthcare stocks that have more or less shaved off as a broad basket, 25, 30% off of their highs on there. And the question that I have is that it's not that they're not going to continue to press their, their agenda on that. But at what point have these stocks fully priced in the worst case scenarios? Like, in the end, the American political system is still a swamp that it involves a huge amounts of lobbyists and special interest groups.
Remember for the haters to send it to Patrick Serezna.
But listen, like, in the end, these pharmaceuticals have a very large amount of money and of deep pockets, and the odds are that almost any legislation that gets pushed through is going to be a little less harsh than the worst case scenarios that a lot of people are pricing in. Can we just agree on this?
Sure, although I might argue that this administration is completely different and is beholden to different lobbyists. And
until the big beautiful bill, I thought they were going to be all dodgy. And
you fell for that. You thought they were going to balance the budgets. Of course you did. You're a bond bull.
No, but the point is that if they flip flopped on that, why the hell can't they flip flop on healthcare? Why is it freaking different?
I'm not arguing. I'm just saying that I think it's more volatile, the outcome. That's all I'm saying.
But my point is, has it been priced in?
I don't know. So you know that better than me. You watch these things better than me.
I'm just saying, like, when you're let's go back to Merck, right? Like Merck basically goes from $130 down 7. Let's just call it a halving. Like Merck goes through a halving, Pfizer goes through a halving, Biogen goes through a halving.
By the way, if we were in Bitcoin, halving would be a good thing.
Well, this is a good thing if long as you weren't the bag holder on the halving. As long as you're buying after the halving, then then it's very much in line.
Yeah.
Right. But but the point here is that it feels like that everyone that was going to sell or had to sell has already sold. And at some point, these things, like every presidential cycle has them attack drug prices. And if you go back to previous times that the same thing has happened, there's a spectacular bull phase that happens in these pharmaceuticals in periods that follow afterwards. All I'm just asking, is this the moment where we start seeing these things bottom? Where we've even like, let's say, take the IBB or the biotechs, they've been generally crawling higher. We're starting to see, that this entire healthcare space is quietly calming down, starting to behave a little bit, starting to uptick a little bit, and everyone still hates it. Everyone's still scared shitless. And that to me is usually a really great buying opportunity. I know this one guy I did a podcast with that used to love buying shit that everyone hates. Do you know that guy?
Don't know him. He sounds like a real jerk though.
Absolutely. No, but you know what?
Listen, I'm with you. The reality is and actually when you said that comment about every presidential cycle has the moment where they're going to go after these drug companies or the medical
often
companies.
I know all of them, but often do.
And I remember actually I can't remember who said it. It was one of the big strategists said, this is going to happen. It happens every time. And then you buy them. And so I'm with you, Patrick. I don't know anything about this sector. I don't trade it, but I must say you piqued my interest. I'm going to go start to learn something about it.
No, all right. Well, if you learn something about it, then share with me. All right, buddy.
Yeah.
Listen, I've got nothing else. I think that this was enough.
Really? You're not going to talk to us about the dollar?
It's in a downtrend.
By the way, what's with the haircut? You got this is looking good, buddy. Looking very fancy. The side things, like you look like little Mr. T action going there. I like it. You're looking good. Listen, I have opposite Mr. T action going on.
Absolutely.
The side and then nothing on the top. I got opposite Mr. T.
There you go.
So you got the real Mr. T, which you can still do. I can't do that. Okay, so you want to call it a day?
I'll just call it a day.
Okay, listen. Thanks for tuning in, everyone. Patrick, if people want to learn more about your terrific service and all these great calls that you have, where can they reach you?
You can find me at bigpicturetrading.com.
And not only that, go check out his YouTube page because Dan's telling me that you got him working on nothing but YouTubes all day.
Yeah.
And I saw it I saw you got to it's coming up on my feed. I actually subscribe to you, so I get the updates. There is a lot of content there. And less cigar smoking, more market calls. I'm liking it.
I'm gonna pull a cigar out the next time. It's just in studio.
This one's for Kev. This one's for Kev. And by the way, a big shout out to the 61 crew, new lows, and you know who you are. Love you guys. You know I'm just kidding you all, but basically all of London owns the 2061s, and there was a new low in that bond, so we have to call them out every time there's a new lows. Remember, you can not pay taxes two different ways. One of them is by buying a bond that has a capital gain, and the other is by not having any capital gains. Okay, you gonna ask me where they can find me, Patrick, and finish this nightmare off?
Kev, where can they find that amazing newsletter? By the way,
go to
all of you need to subscribe and read his vol piece. It was really, really well.
Oh, thank you very much. And that one, big shout out to Macro Manvier. He was terrific. It was a great, one of the great, friends that I picked up along the way in my time in London. And it was terrific to work with someone and be able to really figure it out so closely. They can go to the macrotourist.com. Listen, bear market, bull market, we're just happy to spend some time together on this crazy ride. Now stick around for the after show. Are we going to even rate beers?
Yeah, no, I can't rate this like that. I've drank Super Bock on this show like 7 times, and so like if I rate it and I rate it everently than the prior times, then
people will check it out and know there's no consistency on this show. There's no
consistency. Like he just makes shit up.
It will be like, yes, you're absolutely correct. There is no consistency.
That's it.
How about you? Have you ever rated Corona?
I have rated a Corona before. I think it's okay. I think it's a cool, refreshing, hot summer's day lager.
Yeah. So Danny Boy made it his way all the way back up to the island. He's back in England. He left Portugal, but not for long, I hope.
Oh, absolutely not. No, I'm as soon as I can leave, I will leave.
We're going to transplant. I'm going to take a spot in England since I had so much fun there and enjoyed everyone. So, enjoyed my time.
I tell you what, you can just take my spot and then I won't go to Canada. I'll just go back to Portugal. You can just come here.
You're not coming to Canada. You don't like the cold?
I'm good. I don't think I have enough money to live in Canada anyway. So.
Well, listen, it's cheaper than London. It's not as cheap as Portugal, but it's definitely cheaper than London.
Yeah, that's why I chose the cheapest place in Europe to live. So
yeah, but like London's kind of like divorce. You know why it's so expensive? Because it's worth
it. Absolutely not.
Okay, well, listen. Do we want to chat? Big shout out to our American listeners. Happy 4th of July.
Yeah.
Please try not to light anything on fire with your fireworks or do anything of the sort. I'm not really sure what they're not deep frying turkeys or anything, but they do love doing fireworks. So That's probably a little bit of a fire hazard there.
You're such a concerned dad.
I am.
Hey, just guys, take it easy. Like,
I'm like, Patrick would be like,
actually,
yeah, let's go. Let's go.
Patrick's
like that, guys. You ever seen that Russian dudes that they one time they got they literally, maybe it's Ukrainians now they think about it. I thought it was Russian at the time, but they put fireworks on a drone and then they sent their friends off running and then they were firing from the drone at their friends and they put the the CCR tune over it, like, the one that's in all the Vietnam movies. It's like a great clip. And you know what? I couldn't find it the other day. If anyone has that clip or knows like a link, please share it in the YouTube comments, because I'd love to get it back. It's a terrific 30 seconds of video. It's awesome. And they're crazy. That's something what Patrick would do.
Absolutely. Are you doing anything for you take the day off tomorrow, so you're doing something for your
I was just telling Daniel that I'm going to go to Algonquin Park, do a little Canadiana.
I'm doing the new European thing for me, which is you get in a car and go on a road trip.
Oh, really?
I'm gonna punch it all the way to Italy.
Really?
Yeah.
Honestly, are you?
I'm
serious. Driving in Italy?
Absolutely. It's
Italy?
ridiculous. I'm gonna go to Portofino.
Patrick, we talked about this.
What?
You're trying to be a man of the people, and last time it's Ferraris and now it's Portofino. You should have said you were going to you should have made something up. Not
and
like
then
going and hanging out with George Clooney or whatever it is. Well, I'm surprised you weren't at the Bezos wedding.
Yeah.
I didn't get the invite. And I would have gone. I really would have. It's
you could have just said you got the invite, but you lost it.
What do you give as a gift for getting invited?
No, they didn't want gifts. They said that there's no gifts allowed.
Well, you know why, don't you? Because everybody's just going to get it off Amazon. So,
yeah. What do you Can you imagine trying to get someone a gift like that? I had a situation, obviously not that level, but I had a situation like that, and I don't want to say too much because that person, I don't know, they would listen. But anyways, long and short of it is, I think you have to kind of make something, as corny as that sounds. You have to really think about it. You have to go, this person can get whatever they want. You have to spend time and effort on it in terms of your.
Sounds too hard.
That's what you're giving. So you have to think about it. It has to be something really thoughtful, and instead of just a
yacht.
Yeah, a yacht. Because they can buy themselves a yacht. I already have that one. That's what Jeff would say. Okay, well, anyways, happy 4th of July.
Yeah.
Patrick, drive safe. Daniel, have a great time in London.
Don't
Enjoy
drown
yourself.
On the portaging trip there.
No, I'm not.
Are you getting on the canoe?
No, I'm not doing. I'm going with the wife, and she's not a big fan of that. Actually, it was a last minute thing. Because she doesn't like tents, and I found a tiny little cabin. I was like, okay, I'm going to take it. I grabbed it.
Nice. That sounds good.
So it'll be fun.
All right.
Okay, everyone.
Enjoy.
Take care. Have a great time.
All right.
Happy 4th of July, everyone. Bye-bye.
Cheers.